What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on NIO. Now, this is an auto manufacturer based out of China, and they manufacture electric vehicles. They've been making headlines, and they've had a pretty decent run up in 2020, and since 2021 the stock has been beaten up. However, I want to look at this company and dig into the fundamentals, the financials, and finally determine a price to pay for this business. So we're going to load this up into the stock research tool and let's see what that looks like. So we have NIO loaded up here in our stock research tool. This is something that I've built, and we're going to load up our first category, and that is the company metrics. Now, folks, what I like to do here is look at the company's 5-year averages in certain areas and compare them to the trailing 12 months to try to gauge where this company is currently headed, and let's see if they're making improvements and stuff like that. So in the case of NIO, we don't have a PE ratio at all. We're sitting in a negative range, and we don't have anything for our 5-year average. Our EPS is also negative. Some improvement, as we can see, we've gone from negative 28.66 to a negative 5.45. Still negative, and it's not great. Return on equity, we're sitting at a negative number for the trailing 12 months, but our average is 3.86, so positive numbers, so I'm somewhat concerned about that. And our profit margin is, well, not available for our 5-year average, and it is in the negatives at negative 11%. Right off the bat, I'm telling you right now, with NIO, I'm not impressed, as we're sitting with a lot of negative numerics. Jumping into our revenue, we're at $36 billion. A lot of negative net income, so we're not really pulling in some money. Let's just jump into the free cash flow statement here, folks. So I'm going to just do this. And let's take a quick look at that. Yeah, so 2017 here, huge negative numbers. We are sitting at a positive for the first time ever. 2020, and the last time we actually had a report, so they had to report the 2021 numbers. And we're now finally getting some free cash flow, or positive free cash flow, rather. They're turning this business around. So let's jump back in to the company metrics here. So we're positive with the free cash flow, negative on our 5-year average. Return on invested capital is negative across the board, and we have a very low Altman Z-score, which is very concerning, at 1.25. We want this number to be over 3, folks, and we don't have that. It's at 1.25, which means they're at a risk of bankruptcy, and a Piotrowski score of 5. We want this number to be between 7 and 9, 9 being the highest score we can possibly achieve, and 5 is fairly mediocre. So my impression of NIO is simply this. We have a lot of negative numbers still that we have to work through, and the company's been on the market for around 5 years, and we're somewhat correcting that. We're getting a positive free cash flow number for the first time being reported. However, I'm not too thrilled with the negative return on equity for the trailing 12 months that is now taking over our 5-year, well, would be positive average. So let's do a further deeper dive into the business. We're going to jump into our next category, which is the financial evaluations section. And what we'll do here is essentially the software will provide a score for this business. And what we're looking at here, folks, is we're ranking this business a 6 out of 10. So let's go through the categories. First, we'll start off with the negatives. So where it's not earning points is in the 5-year PE average, as I expressed, because we just do not have it. But if it's what we've been shown so far in the company metrics, it might just be a negative number, and we don't want that. Return on equity average, another problem. We want this to be over 15, and we don't have that. EPS growth, it's technically it's negative. I mean, it's huge. It's showing a huge decrease, but technically we've gone from one low negative number to a higher negative number, so it's not absolute value. So, but nonetheless, we have to rank that as 0 because we don't have, well, any earnings per share. We're in the negatives, and obviously our return on invested capital is sitting at a negative 107%, which is absolutely horrendous. We want that number to be 10% or higher. So that's it for the negatives. Let's jump into the positive side of NIO and see where they're earning points. So where they're earning points for me is in their current ratio. The current ratio indicates to me that sitting at a 2.18, that they have enough assets on hand to cover any liabilities. That's a positive. We want them to have be able to cover those liabilities if things were to go south. And with an Allman Z-score of 1.25, that could potentially happen. Now, our debt to equity ratio is also really good. We have it at 25.80. Now, what that number indicates to me is that they're growing the business through equity and not through debt. So we want that number to be below 50%, and we have that. Phenomenal. They're decreasing their shares by a lot, so hence the low share dilution, which I'm very impressed. Actually, let me just pull out here for a quick second, and let's look at our share dilution. Yeah, so outstanding shares, we're definitely been dropping. So I mean, I wonder if are they actually not diluting you, or are they doing reverse splits? That's the one thing I gotta take a look into, because that might mess with the software just a little bit. But share dilution, if this number is correct, and they're taking away shares or buying back shares rather, that is phenomenal. We want the company to be buying back shares if the stock is cheap, because that means you, the shareholder, will get more ownership of the business. Now, our net income is growing, so we have some growth over the last 5 years, so we're going to get a point there. However, keep in mind, folks, we are still in a negative realm, and we obviously want to be in a positive realm, right? So 5-year free cash flow growth, yeah, we've just established that we've had some growth there, and our revenue growth is growing a lot as well at 77% over the last 5 years. 6 it's a pretty mediocre score, to be honest with you. This is something that I would pretty much just put away and shelve and say, you know what, when they have more positive numbers, then I would come back and look at this business. I need them to just crush some of these negative numbers first before I can even consider, let's say, opening up a position. But for you, the viewer, I will make sure to do a full analysis, because this is what you came here for, right? You want to know what this company is actually worth. So sitting at a 6 out of 10 on the financial valuations category and with negative numbers, we're going to jump into a price analysis and determine what a fair price to pay for NIO would be. Now, folks, if you're enjoying the video thus far, make sure you smash that like button and hit the subscribe button. It makes me feel warm and fuzzy inside, helps out the channel a lot, and allows me to make these awesome videos for you. So let's jump into a price analysis and figure out some assumptions for this business and how they might perform over the next 10 years. So let's do this. We're gonna go into the price analysis category with a 10-year evaluation, and we're gonna look at these numbers here. Now, here's the thing with brand new businesses. Well, not brand new, but it's a 5-year business, and while we're playing with some negative numbers, I'm gonna have to speculate on some numbers here. I have to also be conservative. These are 2 key things. So I'm gonna populate these boxes here, and we'll touch base in just a quick second, and I'll let you know why I chose the numbers that I did. So stay tuned in 1 second. These are the numbers that I've populated with the price analysis. So I have to go conservative on our revenue growth because we're looking at a 10-year outlook. I don't think it's sustainable for a company to grow 77% all the time or 50% all the time. So the estimates that I'm going with is 25, 27, and 30. Now, these numbers are somewhat slightly aggressive to my standards. However, this is an EV business that it's all the rage, it's all the hype right now. It very well could perform these numbers, and granted what we are currently given in the software here and what they've been performing over the last 5 years, it very well could happen. Now, with profit margin and free cash flow margin, this is where it gets really tricky, because we're sitting at negative numbers for the profit margin as well as our free cash flow margin. So I have to assume a low profit margin of 5% on the low side, 10 in the moderate, and then 15. Now, these are numbers that have never been hit, so this is just me speculating. All right, so with our free cash flow margin, it's the same thing. I played around with the 1-year number, putting it at 2% free cash flow margin. I'm gonna go with 5 and 7% because they probably will improve those numbers, let's say, over the next 10 years or so. But also, I want to try to keep it as low and conservative as possible. And ultimately, with the price to free cash flow, we're going to go with the 14, 16, and 18. So this is somewhat of a conservative, aggressive approach, as well as our PE ratio, 14, 16, and 18. Granted, we're seeing at a very high price to free cash flow number, as well as our PE ratio is extremely high as well. Or sorry, extremely low as well. It's at negative 57. So we'll see what we'll see what the software spits out. But here we go. So we're gonna do a desired return of 13, and this is what we got, folks. Our average calculation comes out to $11.99. The current price is at $21.93. A far cry from where we once were. We were at $62 in January 11. So here's the thing, folks. Like, these are the numbers that we're spitting out, and that is if you pay today for NIO at $10.76 based off these metrics with a 13% return, it would be considered a buy. We're currently well above that price. However, we are also not in any sort of realm with these metrics. Ultimately, folks, we want to put ourselves in a position with any kind of investment, such as NIO, where we want to give ourselves an ample margin of safety. Now, with a company like this that is somewhat new, this is a business that I would just completely avoid, because, as I was saying earlier, we need more positive numbers on the table that we can actually work with and try to grasp where this company stands to actually get a more accurate analysis, essentially. Because, look, with a 70% revenue growth, that's not sustainable over the next 10 years. So this is why I've done my low assumptions at 25, 27, and 30. With a margin of safety, we want to put ourselves in a predicament where if we're wrong, we're not going to lose as much, and if they exceed our assumptions, then you know what, that is just, well, better news for us. Now, with this business here, there's a lot of runway, and I've covered a lot of EV vehicles in the past. I've done Rivian, I've done Lucid, I've done Tesla. Now, EV vehicles are one of those things where, you know, the ball is starting to roll. Now, will they be around? There has been tons of car companies that have come and gone over the last 100 years, right? The question you have to ask yourself is NIO this business? Investing in this company, you have to also keep in mind the numbers that are coming out of China. Can we actually agree that these are the more accurate numbers? Are the numbers worse? That's one thing, because these numbers are not that great, folks. Are you willing to stomach this business up and down? And it's like, I mean, I don't know. I mean, I wouldn't be able to stomach this, to be honest with you. To me, like, this is extremely overpriced. It's just a no from me. If you're currently invested in this company and this price is going down, and you truly believe in this business, then this to you would be a buy all day, sitting at $21. Personally, I would just avoid it, because there's a lot of things that need to happen for this company to be a buy. I mean, I'm glad they're making improvements on the free cash flow. However, those are my thoughts on the business. If you're interested in obtaining the software that you see in front of me, send me an email. My email will be in the description down below or on my channel page. And make sure you check out one of the videos in the top right hand corner. You can find it. No, this one. Is it this one? No, it's this one. I was right. It's this corner right here on some of my other stock analysis videos. I've done Tesla, Rivian, or one of those videos should pop up right there. So definitely take a look at that. Anyways, folks, that's the video. Those are my thoughts on NIO. Overall, avoiding this company, and potentially you should too. Anyways, see you in the next one. Take it easy.